My name is Simon Mikhailovich. I'm the managing partner of the Bullion Reserve. And the topic today, or I guess the title of the topic today is Virtual Rubber Meets the Real Road. What's been interesting, what I've been observing for the last several years, and those who've seen me speak about it, is essentially the impact of the developments of the last 30 years that, to my mind, revolve around financialization, digitization, and globalization, all of which have produced a certain set of conditions in the financial markets that everybody has been very happy to observe in terms of continuously lower interest rates, continuous supposed absence of consumer goods inflation, and a lot of other benefits. But in the past several months, we've seen disruptions in the supply chains. And to me, that part has never been, this is where the rubber meets the road. That part has never been anybody's focus. There's a concept in financial affairs called counterparty risk. And it's typically understood, or the definition of counterparty risk is a risk that one of the parties involved in a transaction is unable to perform its obligations. It has always been understood inherently that the parties to financial transactions are the buyer, the seller, and maybe the broker in the middle or something like that. What is becoming clear with the supply chain disruption is that there's been unseeing behind the scene proliferation of counterparties that we have all taken for granted. It's the same thing with digital assets. It's the same thing with goods and services. There's a buyer and there's a seller. But we've come to expect everything showing up on our doorstep. We push a button. 3 days later, the goods are here. That's at a personal level with, say, Amazon. For the manufacturers and industrial companies, they put in an order. 30 days later, it all comes to your door, pelleted, shrink-wrapped, sorted the way you want it, just in time. And so we've built this just-in-time world in a lot of different spheres. And now this just-in-time world has run into a problem. So the question that I want to talk about today is whether these are temporary, whether these are permanent. If so, what is temporary, what is permanent, and what is the potential impact? And so for that, I found a gentleman who I think is a perfect person to talk to us about this, or talk to me about this, is Russ Kennedy, who is not a financial guy. He's an expert in supply chain and logistics. He's got 15 years of experience doing just that. And so he could bring some connection, I guess, between the real world and how we've perceived this real world through this virtual prism. So Russ, how are you doing? Welcome to this conversation. Very happy to have you to chat with me.
Yeah, I'm honored to be here, Simon. Thank you. Appreciate the kind introduction and looking forward to it.
Sure. So what to start with? I've heard you speak now, and I sort of understand your take on this. So could you summarize in a fairly, constrained, or I'm sorry, in compact form? What do you see is going on, and why is it going on? Did we negotiate ourselves into this corner willingly, or is this something that could not have been predicted? Is this structural? Is this something that's cyclical and will be abated? Just describe the problem in a sense.
Yeah, of course. So what we're facing now is it's not a cyclical thing. It's not just one of these things that happens. It really is. It's the end game in a lot of ways, and it's ending messily and noisily. Of a peculiar type of globalization where we have, in the West in particular, hybridized capitalism with regulatory capture to serve the interests of an increasingly narrowing pyramid of stakeholders that have control over the game. And it's hard to conceptualize this as most people, have said, well, it's a conspiracy, and it's not. It's not a conspiracy, but it is what happens when a walled garden, is allowed to occur, where you have, on the one hand, deregulation, but at the same time, you also have regulatory capture of other things. And so what we've seen since the 80s in particular is this peculiar synthesis of political interest and financial interest at the expense of Main Street. So Wall Street, and Pennsylvania Avenue, and those centers of power have at some level decided that what's good for them primarily is good for America writ large. It's good for Main Street. It's good for the rural communities. It's good for the urban communities and everybody in between. And we've lost the thread of what it actually means to build an economy and a manufacturing and a transportation base around things that are good. Um, we convinced ourselves that quarterly earnings reports, maximizing those was good. Maximizing shareholder and stakeholder value was good. And we began to weight all of the incentives and thus the behaviors and thus the infrastructure and the processes of supply chain management themselves around that very narrow concept of what's good for Wall Street is what's good for Main Street.
So let me interject here. What you say, when what's good for Wall Street is good for Main Street. So I've just come upon a very good definition of what financialization is. And the definition is that financialization is optimizing economy around finance and asset prices. And so if you think of it this way, right, optimizing real economy, real industry, agriculture around finance and asset prices. So the management companies, people do respond to incentives. And when incentives are, somebody said, show me the incentives and I'll show you the future. I'll show you the outcome. So the incentives were not to maximize robustness of the manufacturing capabilities, the sustainability of companies, whether it's environmental, whether it's financial, whether it's from contingency standpoint, but to maximize stock price in the short term because management is compensated by the stock options. And so the higher the price of stock, the higher the option value. And of course, all of this is measured in 90-day, quarter, 12 months, 3-year, 5-year increments. And therefore, the focus of the companies and supply chains was to optimize to making as much money as possible, not in terms of real profits from delivering goods and services in a sustainable manner, but in driving up prices. And essentially, insurance in this context is a cost of doing business that reduces margins and reduces profitability. I don't mean necessarily insurance policies, but say robustness of the supply chains. Just in time, well, maybe not quite just in time. Maybe we need 30 days cushion. Well, carrying a 30 days cushion of anything costs money. So if you're trying to optimize to stock options, that's a cost you don't need and you can get rid of and improve your bottom line, of course, at the cost of the kind of fragility that we're seeing now. So I think this is the context for what you're describing. Would you agree with that?
I would, and just in time is a really, really good example. So when just in time kind of became the, that's been around since the 50s. I think was when the Toyota Way, began, but the Toyota Way works inside that particular culture as envisioned. It is a beautiful management methodology that works in the very specific and peculiar context that it originates from. But it's not a thing that can be perfectly replicated in America or in France or in Kenya, because any system or any model has to be optimized around the particular culture that the business and the economy operates in. And so in the United States, because we are not generational thinkers by and large, because our financial models and because our economy is largely geared around what is good for the banks, what's good for the financial system that drives consumer behavior, that drives corporate behavior. Our just-in-time was not around a holistic mindset of continuous and process improvement, which means it didn't mean reduced inventory. Reduced inventory and reduced manufacturing lead times and higher speed supply chains was not the goal. It was an output. The goal was to create a culture that constantly sought to identify and minimize waste and bloat and choke points and bottlenecks managerially and at the operator level. The output was good, but at some point that output became the metric here in the West by which we measured the viability and the robustness of our supply chains. And we said, okay, we can shave inventory here, because if we shave inventory here, that puts another quarter bump on the shares for the dividend for this quarter. Instead of saying are we leaving ourselves shorthanded and exposing ourselves to risk 6 months, 12 months, 18 months down the road that has a much more negative impact on shareholder return? Everybody's screaming for their money now. And so we began to measure and build metrics around just-in-time parameters and said, well, this is just in time. No, it wasn't just in time. It was forcing every single person downstream of that managerial mindset to make whatever compromises they needed to make to hit that metric this quarter. And so that means if they need to switch suppliers, if they need to move from one higher quality raw material to a lower cost substitute, and then we're just going to call it fungible, whether it is or it isn't, but we're going to say it is because it sounds really good in the quarterly earnings report. So yeah, the financialization and the sort of corporatocratic environment that we have, where you have this very in my view, negative synthesis of politics and finance in the US, all of that combined together to really bastardize a lot of these systems that in the correct context, inside the correct corporate and economic culture, they work extremely well, but they don't work well when they are applied to our particular model. So I think at some point we kind of lost the thread and we said, okay, Taylorization, Frederick Taylor's theory of economic labor and how to maximize worker output. We combined that with some form of Austrian school free market economics, with some concept of regulatory capture, with some concept of very short-term thinking, and all of that sort of smashed together to create this extremely fragile, globalized model that we're seeing fall apart right in front of our eyes.
Well, it's interesting because, I mean, what's the opposite of the perfect storm? Perfect storm is when everything goes bad at a highest pitch. So we have created I guess a perfect lack of wind or whatever, or perfect lack of storm, where we felt suddenly that we have this phenomenal free lunch, or this endless stream of free lunches. We have disinflation. We are using cheap labor. We're using materials that are produced at a cheaper cost. We're using a manufacturing base that is unburdened by all the regulatory and environmental and work rules that would have to be borne here in the United States or in in Western Europe. So it was like a perfect combination where we thought, I guess, that we could just have this free lunch forever. We don't need any reserves. We don't need anything. We're just going to build this economy on, essentially, to add to what we're talking about, is subsidizing consumption with debt and meeting this consumption with unnaturally cheap goods and services produced with not slave, but massively underpriced labor,
very much
with
so.
massively underpriced materials, massively underpriced environmental and other regulatory costs. And so that gave rise to Walmartization, Amazon, essentially endless number of SKUs, endless number of choices, shelves that go on for miles, stocked with stuff that I don't know who buys all that stuff or who was buying all that stuff, but I guess they were buying enough of this stuff. And this is kind of coming to an end. And this is kind of what I want to talk about. So first of all, can we delve a little deeper into the actual disruption of the supply chain? And it's like why it's happening, what actually is happening. And while, as we discussed, I mean, there are solutions that will fix this in terms of the most acute disruptions. The cost of fixing it, in the virtual world of finance, you can fix disappearance of virtual liquidity by pushing a few buttons and creating additional virtual liquidity. If the compressor in the refrigerator goes bad, you can't push a button. Somebody has to make another compressor, and then you have to have somebody come in and install it. And we don't have a guy now to install it. It takes weeks to get one. And the compressor is in China, and it won't be made for 2 months. You got no refrigerator. So that's where the rubber meets the road. That's the real stuff. So can you talk a little bit about what's actually going on and why potentially this is, I don't know if the word inflationary is the right thing, but why this is going to cause higher prices, lower variety, less choices, and a very different way of how we receive consumer goods and how the landscape looks for us in terms of living expenses and for necessities and things like that.
Yeah, absolutely. So I'll try to give a 2-minute crash course in how a purchasing cycle works, and we'll use the example of United States and China because that trans-Pacific trade is really the hub or the baseline of all global maritime trade is driven by what happens mainly between China and North America. So a purchasing person at a company, we'll say Walmart, um, there is, before that stuff ever even gets stuck at the port, there is a very long cycle that happens ahead of it that has to do with demand planning, forecasting of consumer behaviors, what the hot trends are going to be, what moves and what time of year. So it's all very cyclically driven by historical demand, but also new demand that may come from things that are very popular, PlayStation 5s or whatever it may be. So the purchasing people at Walmart are making the decision on where do I manufacture, when do I manufacture, and how much lead time do I need to put a purchase order in and pay for those things, get them made, get them on water, get them to the United States. And that stuff is not set on the fly. That stuff is set weeks or months or even a year, in some cases, ahead of when the goods are actually going to be manufactured. So when we shut everything down, when China shut everything down, in late December and then January and even into early February, right before their Lunar New Year.
Of
the
2020.
Purchase orders of 2020, correct. The
Right.
purchase orders that had been planned did not stop going to China. They were still flowing in. Those factories were still receiving a backlog that just continued to build of things that had to be made because eventually the gamble we were making in the US, because we have to hit quarterly earnings reports and things like that, was that at some point China's going to come back to work. Those things still have to be made. So I need to be next in line. And so while the factories were shut down for that 6-8 week time period in China in Q1 of 2020, the backlog of purchase orders and things to be made were paid for and were ready to go the second China came back to work. So you had this just percussive, explosive demand of manufacturing that had to be done the second China said it's safe to go back to work. Simultaneous to that, though, nothing was actually being made. So the ocean carriers that we depend on for 90% or more of the commerce between these two continents, they pulled all their capacity out because they didn't want to have all these ships and crews burning fuel, just sitting there waiting for weeks that may not come for China to turn back on the tap of manufacturing. So they pulled everything out. So China came back to work very quickly. It was a V-shaped recovery for them, very much so, starting in March of 2020, late February even, and into early March. But it took months for the ocean carriers to adjust and flex all that capacity of containers and ships back into the trade. Purchase orders continuing to climb, manufacturing slowly coming back online, but certainly a lot faster than the carriers could put back in. The congestion that we're seeing now did not begin when the ships started getting backed up in Long Beach. The congestion we're seeing now began all the way back in March and April of last year, of 2020. And that's because of the peculiar, over-optimized, and very fragile globalized supply chains that underpin this idea of we think only short-term in the US. If we had a purchasing and procurement construct or mindset in the US that was built around longer lead times or not trying to be so responsive immediately to trends, we would have had the ability to engage in some strategic sacrifice, slow the purchase order cycles down, allow the factories and freight cycles to catch up with each other, and things would it have sucked? Yeah, but it would have at least been a lot better than it is today. And we probably wouldn't be in a situation where there's 70 ships sitting at anchor or drifting, waiting to berth. It would have been a situation of 5 or 10, like it was in September, October, November of last year.
So, okay, as you and I discussed, I mean, there are some solutions to this, and at some point, some of these backlogs are going to be cleared up. I mean, it'll take some time. The real question is, are we going to go back to 2019? Because a lot of people think that what I just said means, okay, everything will clear up. We're going to be back to 2019. China is going to continue to produce cheap stuff, cheap energy, cheap everything. uh, inflation is transitory, and everything is going to go back to normal. So, from my point of view, I don't think that's in the cards. I think a lot of things have changed. I think a lot has been revealed to the companies. A lot has been revealed to the government and security agencies as to the critical vulnerabilities in industrial defense-related components, in drugs that are not made in the United States and strategically unavailable potentially as and when they need to be available. And so how do you see these factors? And of course, in addition to that, China is undergoing a very serious policy reassessment. The full impact of which is, I've been following it and I've heard different people talk about it. And there's some differences of opinions. The conventional wisdom says, well, they're going communist, down to more thoughtful people explaining that China is basically acting in its self-interest to protect itself from the undue influence of reliance on the U.S. dollar. And the reliance on the Western financial system that comes with that. They're about to come out with digital yuan. They would like to bring their currency into international settlements. They have demographic problems. There's been a report earlier this year that shows that the Chinese population is not growing as fast as people thought. So that may put pressure on the labor availability and maybe on the desire of China to continue to provide, cheap, unlimited labor to the West, being basically a swing producer to the West. So how do you see these issues? I mean, are we going back to 2019? Is this just sort of a dip that will be worked off, and then we're off back to the races like nothing ever happened?
No, I think this is to the extent we can think of anything geopolitically as permanent, I think this is a permanent realignment that we are in. The fifth inning of. So a couple things. Point number one, we know because he's been very open and unwavering about it that Xi Jinping has decided that China is now to be the new global hegemon, or at least the new global hegemon over Eurasia, and more broadly that larger sphere of influence. And to the extent that we can stop that, we have very few ways to do it. The decision has been made and they are moving in that direction. Belt and Road was an indicator, the build out of their Navy was an indicator, the build out of their missile, their offensive and defensive missile capabilities and their space capabilities. All of those are individual data points that taken together collectively point to the fact that China has said you're with us or you're against us, and you certainly don't want to be against us anywhere in our sphere of influence. So that cleavage or that bifurcation that is happening is irreversible. Whatever the West thinks it wants out of that paradigm is irrelevant, because in any conflict, both actors get a say, and it is binary if those are two different things. So China has both the opportunity and the means to force this decoupling. And so because it has decided to do that, China cannot actually attack the West in any meaningful, direct way. And so it's forced into two things simultaneously. What I've kind of taken to calling, privately kinetic decoupling, which is a forced, sometimes economically violent decoupling of their manufacturing base and their logistics capabilities from Western demand. A lot of what we're seeing is a result of that, but they also have to right their ship internally and politically in order for this to happen. A lot of people who mouth Communist Party, Chinese Communist Party platitudes in China are more capitalist at heart, because they've grown phenomenally wealthy with that particular capitalism communism hybrid that China operates under, and they may not go quietly into that good night. And Xi Jinping knows that, and he knows that this kinetic decoupling that he wants to see to force China and the US apart so that he has room to maneuver with his military, with his intelligence apparatus to do the things he wants to do, like take Taiwan. He can't take Taiwan right now because it would crash the Chinese economy right alongside. So we're in this phase where he's forcing as fast as possible two things. Externally, he's forcing Chinese manufacturers, Chinese energy production, everything. He's doing everything he can, and the CCP is doing everything it can to break away from the United States in as quick and violent of a fashion as they can without collapsing the Chinese economy totally. They know it's going to hurt. They know there's a level of strategic sacrifice involved, but in their minds, they're cutting off their nose to spite their face. But at the same time, Xi is also at war with a lot of these elites very quietly inside China who don't want to see that decoupling because it's made them phenomenally powerful and wealthy. And so it's just as they have a dual circulation economic strategy of exporting to the world and increasing domestic consumption, they also have to decouple more from the world and go to war with the elites at home. So this is a time of great opportunity in Xi Jinping's eyes, but it's also a time of great risk for the entire CCP, Communist Party. In the West, then, this is forcing a choice on us. Do we want to be, to the extent we can continue to be operating with factories and our supply chains nearshored from China to places like Vietnam or Thailand or Indonesia or India, but still within that risky sphere of influence? That's a game theory calculation of how closely do we want to be tied economically and from a national security standpoint to that region, and how much do we want to actually bring back into the Western Hemisphere and into U.S. shores. When you're talking about a lot of I'm not going to say they don't love their country. I'm not going to say they're not patriotic, but the calculations are very different for the Western financial and corporate elite than they are for the Chinese financial and corporate elite. The risk here is of losing power and losing wealth of a particular kind. The risk for those elites in China is comply, get out, or face death. So this is an ideological existential conflict as much as it is an economic and national security one. And the die has already been cast. We're not going to go back to 2019 because Xi Jinping has decided we're not going to go back to 2019. He's decided that this is going to be that moment of bifurcation. And this is going to be the moment where the West is forced into a choice of get with the Chinese agenda or be at war with the Chinese agenda, as determined by Xi Jinping. So that's a very broad answer, but it's also an explanation that no matter how much we may wish in the West, why can't we just go back to all the things on the shelves and nobody knows about how many ships are at anchor off the coast of Savannah or Long Beach? As much as we wish we could go back to that, that's magical thinking, because the other actors in the system have decided it's going to be different. And because of that, it is now conflict up until the point we achieve some form of resolution one way or another.
And of course, from the United States, we've seen that China has been designated as the number one opponent, with Russia sort of close second, but China as the number one. And so in that context, this is not just the Chinese are doing this. We are doing our share from this side. And of course, in the context of China, as you correctly pointed out, it's, if they tap a private company on the shoulder and say, no, you don't get, this is what we want you to do, or else in the United States, it's not quite like that, but it naturally will have to, our companies will naturally have to adjust their thinking and their ways to reflect the reality on the ground. Like, for example, the Chinese are not exporting fertilizer, period. Mm-hmm. Right? I mean, just not doing it.
That's correct.
Well, I mean, that's a huge problem because, without fertilizer, the crops, the food yields are tremendously lower. We have not invested in hydrocarbons for 10 years now because of the green technologies. But here we may be in the position where we need more energy and we're not ready with the clean energy yet. So what do we do? I mean, not heat the houses. So I think the interesting thing what you're saying is to put it in a bigger context in the financial sense is that we have had an economy built, or we've had a model for the last 30 years built on virtually unlimited access to cheap and cheaper, continuously cheapening capital, unfettered access to cheap and continuing to stay cheap labor, unfettered access to manufacturing and supply facilities that are unburdened by all kinds of regulatory and other costs that they would be burdened by if done in the West, and consumers whose demand is subsidized by continuous money printing or borrowing, if you will, to consume all the stuff that's cheaply delivered from all these places from which it ain't coming, not in the quantity as we've expected. And the entire financial infrastructure is levered to this business model that I just described, with the levels of debt and leverage that we've never seen before. So something's going to have to, I mean, I'm not suggesting that what you're describing is the end of the world, but what I'm suggesting, it's probably has to be the end of the world as we knew it, and of the business model and the growth model as we knew it. And this is an emergence of two kinds of risks that dominate financing in general, and that's correlation risk, which is also known as systemic risk, where the risk is not pertaining to a particular company, to a particular product, or a particular situation, but is overarching and is extremely dangerous because, you know, the concept of putting all your eggs in one basket or not putting all your eggs in one basket gets completely defeated when you realize that all the baskets into which you place your different eggs sit in one larger basket that's about to be dropped. And then, you know, all these other baskets that you think you're diversified, you're not diversified. That's problem number one. Problem number two is the emergence of massive counterparty risk, which is not the buyer and the seller, but innumerable number of links in the middle of the chain, both in the digital world and in the real world. In the real world, it presents itself is logistics and supply chains where numerous counterparties have to perform just so for the goods to appear where you want them to appear at the time and at the cost that you envisioned. And in the digital world, in the fact that, particularly if we're entering into some sort of a unfriendly environment with China, you know, cyber war is one of the factors there. And in the cyber world, and that pertains to all digital transactions, interactions, assets, not just crypto, all digital assets, stocks, bonds, everything that's been dematerialized and digitized, which 95%, I think, of securities are dematerialized, exist only in digital form, is you have massive counterparty from in the digital sphere, because the internet service providers, internet backbone, software, hardware, updates, development, settlement networks, all of that is exposed to cyber risk, which in a confrontation with China, where you can't use nuclear weapons because that's going to kill everybody, is probably one of the fields of operations. So it seems to me like what you're describing and how it fits with my worldview is we're essentially to transition into a world with different cost structures, probably higher costs for essentials for everybody. I'm not saying this is inflation in a conventional sense, because to the extent that people have to pay more for food, maybe they consume none of other things, or a lot less of other things that they used to consume prodigiously, various toys or whatever. By toys, I mean electronic toys and other adult toys that people have been consuming. Maybe you don't have 17 pairs of shoes now. Maybe you only have 2, or 3 or 4, or whatever. So this is an environment potentially of higher costs for essentials, maybe lower costs for non-essentials, but potentially lower standards of living for many people, which translates into political implications. Would you agree with that?
Yeah, I would. On the macro level, I very strongly and actually was just published or will be published here in the next few days in an anthology of papers that was written by a bunch of extremely smart people and then me. So I'm not sure how I snuck into that room, but that'll be published by RBI, one of the Austrian banks, and it's going to be storms ahead. So discussing a lot of how geoeconomic and geopolitical risk is going to shape a lot of things in the world, and my contribution was on the supply chain piece. And so at the macro level, the defining frame or conflict of the next, I would say 25 to 30 years for sure, is going to be the bifurcation of the world into a Chinese-led order and to a US-led order. It is not a new Cold War. It is not a Soviets versus the US redo, because these are fundamentally different paradigms. And that's a really, I think, simple and incorrect way to understand or frame this conflict of ideas and civilizations. But at the macro level, that's the piece. At the micro level, it's exactly what you're talking about, where consumer behaviors, whether we want them to or not, are going to have to change. Thus, the financial incentives of the retailers and the wholesalers and distributors and this whole ecosystem of people that meet human need, all of these things happening means that a single mom somewhere is going to have reduced optionality and increased prices to feed her family. And a dad who, maybe he had a white collar job that he was, he was in the supply chain or procurement function for a massive importer that manufactures overseas. Well, his job's probably going to go away because his specialty was certain items in a certain country, and that is relocating to another part of the world, and maybe he doesn't have the language skills to interact with them. So now that guy is out of a job, and he has to go find something doing what he was doing, or he's going to have to retrain his skill set around something else. And so the compromise that a lot of people are going to have to make because of this war of ideals and this clash of civilizations, which certainly this bifurcation and differentiation of how the world should work between China and the United States, is going to be put a lot of Americans in a situation where they're going to have to make very difficult choices about what they want to do with their careers, how they want to consume things, and the manner in which they meet their needs at the individual and at the family and community level. And so I believe that the greatest opportunity for America in the next 20 years is going to be a revival of the trades, both in what we consider traditional trades, whether it's agriculture or maintenance and engineering and things like that, the sort of the traditional trades, or new forms of the trades, which is advanced metallurgy, being able to work with 3D printing, being a resource. And if the U.S. pursues the strategy of maybe barbelling its economy in the next 20 years, where we master the basics again, the downstream, the raw material, we become really, really good again at making basic things, but we also maintain and even extend our dominance and our posture around hyper advanced technologies, metamaterials, energy systems that actually work, not that are just a bunch of fugazis that pay off politicians in China and in the US. We can achieve all of these very noble goals of decarbonization and all of these other things. We can also achieve an economy where the average person can get paid a good living wage for them and their family without massive subsidization of their lifestyle. They're going to have to make some sacrifices. And then the people living in the clouds are also going to have to make some sacrifices. But if we can do that, if we can break this model of we're a consumer-driven economy that requires cheap stuff, that is the third way. That's that middle path forward between this ideological conflict of nations and also this fear, uncertainty, and doubt the average person has that it's all collapsing around me. What do I do?
Well, I mean, this is critical, but it's also critical to understand that the way from here to there cannot be quick, cannot be cheap, and will not be cost-free. It would be extremely expensive. Like, for example, we have dissipated our high quality labor or high skill labor infrastructure. I mean, there is a whole, like in Germany, for example, I mean, there are countries where there's a tradition, and we used to have this tradition of apprenticeship. There's infrastructure of apprenticeship where older workers train younger workers who acquire over 5, 6, 7, 8 years the fine skills that are required for, high value added. I mean, one thing, I'm just interrupting myself, but one thing this technological progress have done is that as you keep breaking down the tasks into smaller and smaller pieces, as computers and automation takes over, the value of each piece of labor becomes less and less. And this is one of the ways how labor had lost its voice and lost its leverage, because now it's competing with automation. You don't need a highly qualified worker who understands the process, these 7 steps. You only need a person to understand 1 step. It's much less valuable, much less leverage. It could be easy to replace. So we have lost through these sort of processes and through competition from China, where you could get all this labor for nothing, or not for nothing, for much less. we've lost a culture of highly skilled workers and the tradition. I mean, it was a whole community. I mean, people were proud of being, needed by companies and knowing, even though they were not management, but they were at lower level, but they were experts at what they did. So that's a generational thing. I mean, this is not going to take 3 years. This is going to take 10, 20 years to retrain and bring all that back. Second of all, it's all going to be much higher cost because doing this in the United States, I mean, I heard one of your podcasts where you described like even down to the palleting and sorting and that part of logistics, which is labor intensive, when everything arrives in a container where inside there's a pallet for each customer, sorted specifically in the order it was requested with shrink wrap and whatever, all the packing materials. I mean, just to do that same operation in the United States would cost multiples that it did in China. Getting everything, the logistics chain, getting everything to Port of Los Angeles and putting it on the terminal that's right there is one thing. Now in Topeka, Kansas, there's one plant. And in Chicago, there's another plant. And somewhere else, there's a third plant. And at each plant, the truck has to pick up the stuff and it has to get it to the local, railroad track, which we have gotten rid of the local railroad tracks. I mean, now it's all, one centralized. So, I mean, we have massive work to do here. And of course, on the positive side, it's going to require investment. It's going to require development. It's going to require more jobs, more vibrancy.
There you go.
But you can't have that without shedding and cleaning up the incumbent infrastructure and incumbent balance sheets that are not geared up for any of that don't have room for new investment because they're so geared up to doing things the way they've been done. So, I mean, I guess what we're saying here is what we're coming to is a very large reorganization. And one thing you said I want to comment on is the difference between this situation and the Soviet Union. The Soviet Union, or the confrontation with the Soviet Union, was political, military, and ideological. It was not economic in the sense that the Soviet supply chains and the Soviet economy and the Soviet financial world were in no way connected, really, to the global supply chains, to the global manufacturing. They exported energy, and that's about it. They were not really a part of the global supply chain in terms of goods and services. And nobody relied on Soviet-made anything, pretty much, except for maybe, their satellite countries.
Anybody that was part of the Soviet Union.
Exactly, part of the Soviet Union, yeah, bad shoes. They say that the Soviet Union fell apart because people got tired of wearing Romanian shoes. Bulgarian shoes. I grew up wearing Bulgarian shoes, not that good. And so a lot of calluses. And so this is a very different situation. I mean, this is not a free lunch. I mean, this is just not going to be a free lunch. And it's going to have massive implications on the money. It's going to have massive implications on the markets, on the values of different companies. And this whole edifice of business models and financing and leverage that we've built, I think, is coming. Basically, the rubber is meeting the road. And it's two things, basically. It's this crisis of COVID that facilitated Chinese realignment and Russian realignment of interests into building their own spheres of influence and potentially decoupling financially to the extent that that's possible from the United States and from the dollar system. I mean, none of this spells short-term positive. And by short-term, I mean probably a decade. I mean, it feels like we're up for some tough times for a bit until we rebuild it in the way that you're describing. And of course, the political. In the meantime, how do we bridge this politically? I mean, 60% of the people in this country don't pay federal income taxes, which simply is a way of saying it. They don't make enough money to pay federal income taxes. So if you have 60% of the people who are on this edge of the middle class and can be pushed into the lower class through higher costs, I mean, that's a major political force that can destabilize the United States internally. So we have geopolitical, political, social, economic, and financial crises proceeding essentially at a different pace, but in parallel, along a certain path. And it feels like we are somewhere in the middle of this game, where the actual outcomes are just beginning to be visible through the reality of supply chain. I mean, so virtualization meets real world. Titanic meets iceberg sinks.
Iceberg. What you're describing there, there's a term that I encountered a number of years ago that I think is always really adequately described what you were talking about, where you have several lanes of activity happening concurrently, but on different, they're terminating at different timelines, and that's polysynchronous timelines. Poly meaning many, synchronous
Right.
meaning in synchronicity. But so I heard that term from somebody. I'd never encountered it before, but it was a brilliant way to frame the discussion we were having then, but also to frame what's happening in this moment. If we can visualize what you were talking about, geopolitical, right? So the grand game, political within the United States, financial economic, labor constraints, food supply, all of these things, right? Changes are all happening to them simultaneously, but we're not just going to wake up one day 10 years down the road and go, oh, we fixed everything. This is an iterative process that some things will take a year to fix. Some things we could do right now. Some things won't be fixed for 20 years. Because some of this is a skills training thing that has to begin in elementary school for kids. Yeah. My 11-year-old knows how to balance a checkbook. I knew what a checkbook was when I was 11 because I had a bank account at 11 years old that I was like putting my lawn mowing money into, and I had a little checkbook, right? A little ledger. So I taught my kid, my oldest, how to balance a checkbook, even though it's not a skill he's probably going to need to have from a manual side, but that mental discipline of understanding debits and credits, inflow and outflow to an account is something that a child needs to understand, because right now in a kid's mind, it's all funny money, right? He goes to the grocery store with me or Walmart or whatever, and I pay for something, and he doesn't see me write a check and then note the transaction in the log and keeping a declining or increasing balance. All he sees is I put a little piece of plastic into a computer and boom, I get to walk out with it.
Magic.
It's magic. The concept is of what money really is. And the labor that it takes and the value one provides to a company and to an economy to receive the means to buy that thing, it's all completely abstract to that child. And so there's attitudes and things that we have to begin now reshaping in young people that will connect them to the essential nature of labor, the essential nature of education, and being productive and developing skill stacks that serve them in life that will allow them to earn. We have to do that. That takes a lot longer than a 6-month plan to fix the ports. But in America, we have to stop thinking that everything can happen right now with some political fix, some executive order, whatever it may be. It's not going to happen. All of these things are happening.
Well, that's financialization. That's what we did. We dematerialized money. I mean, we're seeing this phenomenon in cryptocurrencies. This is not an opinion on cryptocurrency, but we're seeing how people are chasing things that are completely, Shiba Inu, whatever, that didn't exist yesterday. That's a joke, is now worth more than most corporations in the world. I mean, overnight. I mean, these are the wages of dematerialization of tangible values, of real values. And so I think the discussion, just to close out, we're running out of time, but the discussion that's taking place, or the obsession that's taking place in the financial markets with what the Fed will do and whether it's inflation or deflation, I think misses the point tremendously. I mean, this is not about inflation or deflation. This is about reorganization, a massive reorganization, and potentially devaluation of a lot of things that we valued very highly, and re-evaluation of things which we left for dead, if you will. And certain things are becoming more valuable going forward, and certain things which were valued extremely highly are not going to be valuable at all because the world is changing. So the financial markets have not caught to that. And I think that there's a missing sense in the financial community that to them a crisis is when the markets are crashing. That's when a crisis is happening. My point is the crisis is happening, and it's occurring very quickly on multiple levels, as we discussed. And to understand this crisis is essentially a recipe to being able to navigate with your savings and with your money and with your job and your loved ones through this period. I mean, this is, the first duty here is to get educated and to really understand what's going on, not to think that this train is just going to keep rolling along, singing a song, and everything's going to be fine. It's going to be fine, but it's not going to be fine for everybody in every way. And it's not going to be fine for a lot of financial assets and claims that we've created against things that don't no longer make sense, but still exist as if they're valuable. So I think that's the conclusion and the gist of this conversation.
And really, at the end of the day, Simon, my goal, and hopefully people see this come through here and elsewhere. I don't ever want to be an influencer, right? Like if I'm telling people what to think, they are so hopelessly lost because I'm mainly figuring everything out as I go anyway. So I do want to teach people, though, that iterative process of adaptive thinking, understanding complexity, and systems thinking so that they can recognize data and make choices for themselves that is optimized for themselves and their particular environment. I don't want to tell people what to think, but the goal of my Twitter feed, the goal of my Substack is to teach people maybe how to think, or at least to explore things from a different angle and then arrive at their own conclusion.
Very good. And that's always been my point as well. I'm here to make observations rather than predictions. So to the extent that you can understand what is going on around you and correctly analyze the potential implications, you should be able to make rational decisions. But in the past, people have been excused from that through sort of this fog of complacency and being excused from making hard decisions because everything looked like everything's great. So now that we're encountering real world problems, and I think we'll be continue to encounter these problems and deal with them, it's the value of thinking for yourself and understanding how to create real decorrelation, or how to really diversify yourself and your skills and your finances and so forth from this basket that holds all baskets. Is a critical skill that I think is going to be very valuable, will be understood to be very valuable, and will prove to be very valuable for people. So hopefully we made a small contribution in that direction today. Thank you very much. And thank you very much for listening to us.